Well, Lyft is kicking off the Investor Roadshow to market its initial public offering today. The company reportedly seeking a valuation between $21 billion and $23 billion. Joining us now to discuss EquityZen CEO Atish Davda. Atish, good to see you. We've been anxiously awaiting this. We've talked with you a couple times about the expectations for it. So how does the valuation square with what you were looking for?
They are sky high. Lyft's last valuation as a private company was around $15 billion. And you absolutely cannot blame them for wanting to beat Uber to the public markets. I mean, the way we think about it at EquityZen is that if Uber were to go first and they did well, there'd be pressure on Lyft. If Uber went after Lyft, if Uber went before and did not do well, there'd be a lot of pressure on Lyft. And so Lyft, I think, has a crack team figuring out a way to say, put themselves in front of the market, start defining transportation as a service. $21 to $23 billion is the current range. I wouldn't be surprised if it goes up before the final price comes out.
But what are some of the questions that get asked in this roadshow that the big investors want to know before they're going to put money on the table?
Like, when are you going to make money?
Yeah, because they said in the filing in the S1 that they've been losing.
I think we're going to see that in more and more S1s later this year. But the one thing that's already starting to make a little bit of sound is that the big investors, the pension funds, even the unions and large asset managers have written a letter to the board of the company asking for kind of the same thing they asked for when Snap went public. You know, what's up with the dual class share structure? Founders own 7% of the economics, 50% of the votes. Let's try and do away with that. Let's not continue this trend of Google, Facebook, Snap. I mean, 2 out of those 3 have done well, but 1 out of those 3 have not done well at all.
Yeah. And Vic, I know that you've been looking at the rideshare industry more broadly here as we get these IPOs. I mean, where are we sort of in the cycle of it, right? You're just having these big players go public.
I think this is just the beginning. And so Lyft, I think, will kick it off, and Uber probably follows in a few. I think speculation is that they'll do the roadshow in more than likely in April. But you have several others. Pinterest is another one that's likely to come out this year. There's Airbnb, possibly later this year, if not 2020. So a lot of big names, a lot of investor appetite, I think, for secular growers within the tech space. And all of these companies have a big secular growth stories. And so, I've done a lot of heavy lifting on the industry, the rideshare industry. When I look at it, the bottoms-up work I've done, I'm looking at roughly $1 trillion worth of revenues by 2030 for the on-demand rideshare industry on a global basis. And that's up from 10 times what it is today. And so that's capturing roughly 15% of the global transportation market from 2% today. So a massive disruptor taking place.
When you hear something like that, and I realize that you're talking on a global scale, but Lyft is going to be a part of that, at least here in the United States. And it would seem to me that sometimes you always hear caution if you're a small investor before you jump into something like this. But then when I hear, what was $1 trillion?
I think they'll do about $1 trillion globally.
And that's in the next 11 years.
Yeah.
It would seem to me a small investor might want to get into this, even if this price is somewhat escalated.
That's what our business is all about. Look, what EquityZen does, and obviously this is before the IPO, is allow qualified, accredited investors who want to make a 10-year bet, allow them to make a 12-year bet. So if you're a long-term investor anyway, might as well get in, when you can as a, if you miss out as a private company, get in as early as possible, in a public company, if you have the conviction that this is a long-term secular trend. I mean, Lyft in its own S1 said that only 1% of the miles driven by the American public are using rideshare. I mean, that's a lot of miles ready to go that hopefully AVs, Uber, Lyft, and many other companies are going to try and take over.
But one of the issues you brought up in our last half hour was about millennials. And I think in the S1, the Lyft document talked about the fact that millennials, 34% of them use rideshare, and that's only going to grow.
That's right. I mean, you're talking about the millennials now bigger than ever. Being able to control the dollars, I mean, they're not quite there yet, but in the next 10 years, you're going to see the shift from the population that are currently the boomers, transferring all that wealth into the next generation, and pretty soon you're going to have the millennials who grew up in a totally different world than than the rest of us did, being able to control not just which technology trends are being used, but where their dollars are going.
Okay, I got to put a little pause on all of this. All of this sounds really amazing.
Right.
Like, I buy it unthinkingly because this sounds too good to be true. Like, what are the risks involved in this?
I mean, one big risk is what we were talking about earlier is corporate governance. I mean, you're talking about a principal agent problem that a lot of economists are trying to bring light to, asset managers are trying to bring light to, where you have a small group of managers at the top that own a smaller percentage of the economics than they do the voting power. I mean, there was an article that just came out recently talking about how this battle is still ongoing at Google, where you have Sergey Brin and Larry Page trying to figure out, well, this massive company, one of the largest companies in the world, is still kind of controlled pretty heavily by a small number of people.
Well, Facebook is like that too, right?
Exact same thing. And I think if you take a look at Snap's returns, a lot of folks are saying, I don't know if that's necessarily a good thing. It worked out well a couple of times.
Right.
It's not a sure bet.
All right. Well, we'll be monitoring it. I'm sure we'll have you back on as we get all of these big IPOs. Atish Davda is Equities Zen CEO. Thanks.
Good to be.